to the Mercantile Investment Trust, the home of tomorrow's UK market leaders. So if we could turn to the first page. Before I speak, I would just like to go over why it is we think the UK is such an interesting part of the market and why it is investors should be looking at this part of the market. And here we see the returns over the last 25 years for a number of different stock markets. And we can see the dark blue line, which is the FTSE 250, the mid-cap market, has been a really strong performer over this time period, holding up right up there with the S&P 500 and the other smaller companies' indices. In fact, if we compare the FTSE 250 in this chart with the FTSE 100, which we can see is the third line from the bottom, the returns of the FTSE 250 have been approximately 10% per annum over the last 25 years versus around 5% per annum for the FTSE 100, clearly making a substantial difference to the value of those portfolios through that time period. Why is this? Well, I think if we jump to the next slide, we can illustrate why, but it's ultimately due to the superior growth that we can generate from smaller companies than larger companies. It makes sense intrinsically or intuitively, there is greater potential for smaller companies to grow at a higher rate than there is for larger companies, as those larger companies ultimately become more linked. The growth of those companies becomes more linked to the underlying growth of the end markets. Whereas we can get exposure to nimble business models. And here I'll use WH Smith's as an example, not necessarily one that people will think of as being a nimble business model, but this is a business that of course operates as high street retail, but also travel retail. And despite the huge changes in that retail landscape over the last 20 years, this is a business that has continued to grow its profits by adapting to change. And of course, they don't actually sell products in the high street today that they would have sold 20 years ago, and instead they've adapted and grown as a result. Second area we love to get exposure to is businesses that can either innovate or disrupt. I think Softcat is a great example of this. This is a technology distributor that focuses primarily on selling both products and services to UK mid and small size corporates. And they've taken huge advantage of the increasing complexity of technology over the last 10 to 15 years. And in fact, they've grown their organic sales on an organic basis every single quarter for the last 15 years, which truly is a testament to the success of that business model. And then thirdly, the exposure to rapidly growing new markets. And on the right-hand side, we've used countryside properties as an example, which again might not be intuitive because house building is not a new industry. But within that business, they have what is called a partnerships division. And that is a business that partners with local authorities and housing associations in order to redevelop or re-energize urban living. And they have a huge land bank of potential growth. So they've got a land bank of around 40,000 plots, which is equivalent to about 9 years worth of supply. But they have visibility on a further 100,000 plots, which I think is really illustrative of the demand that local authorities have for this kind of housing solution. So I think the superior growth of this part of the market is truly compelling. Now, if we turn to the next slide, we can give the one-page overview for Mercantile. So Mercantile is, we believe, the home of tomorrow's UK market leaders. So we are looking to deliver long-term capital growth by investing in a diversified portfolio of UK-listed mid and small cap stocks. So by value, the benchmark is approximately 90% mid cap and 10% small cap. And the portfolio is diversified with around 75 holdings. So we're not taking a huge amount of risk in any one specific holding. With that breadth of portfolio, it's important that we have a strong and capable team. And so I look after the UK mid and small cap team, where we have 6 investors who specialize in this part of the market, which I think gives us good bandwidth to be able to cover the full breadth of opportunities. And we on average do around 360 management meetings per year, which is just indicative of the number of companies that we're seeing. The portfolio itself is relatively large, so it's around £2 billion today, which is important for the end investors because there's good liquidity in the underlying shares, and it comes with low charges. The ongoing charges, just 44 basis points, 0.44% last year. Of course, all of that only matters if it translates into superior returns for investors. And on the right-hand side, we can see the returns for Mercantile, the blue bars, over the last 1, 3, and 5 years. And this is data to the end of October. It is pleasing to be able to say that November, of course, we haven't incorporated the November figures, but Mercantile has rallied alongside the market through November. So of course those numbers are looking better. But what we can see is the excess returns against the benchmark, which are at the bottom of that chart, fairly consistent over all of those time periods. And if we jump to the next slide, we can see how that compounds over time. And this just shows the returns. So the blue line, which shows the share price returns, the gray line, the NAV, so the portfolio's underlying returns over the duration since I joined the team, which is the last 8 years or so. And we have grown the NAV at around a 10% annual growth rate through that time, despite the challenges posed by COVID through this year. And we can see that that is substantially ahead of the benchmark, the FTSE All Share, excluding the FTSE 100 and the investment trusts, which has delivered a return of just 77% in total through that period. And those returns indeed dwarf the returns of the FTSE All Share through that time period. Now, if we jump to the next slide, that will just add on the income generation story, which I think is important. And it is great benefit of an investment trust that has the ability to smooth income over time. And we can see here that Mercantile dividend has grown at an 8.5% compound annual growth rate over the last 30 years. And in addition, the board has indicated that for this year, so for the financial year that ends in January of 2021, the dividend for that year will be at least in line with the dividend paid for last year, which is clearly a great benefit of being an investment trust, the ability, as I said, to retain income and thus smooth the dividends over time. So what is it that we're looking for in our investments? If we could jump to slide 6, please. This will show our investment philosophy. In simple terms, we're looking for good businesses. So we're looking to, as I said, we meet a lot of companies, we talk to the management teams, and we really care quite strongly about not just their business model and the sustainability of the earnings, but how they're going to allocate capital and thus drive future returns and future growth. And of course, one of the things we do is we hold up the management teams to what they tell us. And so those companies that deviate generally don't stay in the portfolio for long, but those that are successful will continue to back year in and year out. Of course, we look at the valuation of the shares. There's a difference between owning a good company and owning a good share. And we think about the valuation. Predominantly, we think about the cash flow characteristics of the business and the enterprise that we're buying a share in, and whether we're able to generate a strong return from that cash flow. And then third, and in many ways, one of the most important levers, we're thinking about what is the outlook and is the outlook improving? And here I'm not just talking about over this quarter versus last quarter. I'm talking about over the duration of the investment case. Do we think this business will deliver better returns over the next 3, 5, 10 years than the alternatives? And how is the market currently viewing its potential? Because of course, the stock market is all about balancing expectations versus outcome. So it's our expectations versus the markets. So in order to bring that investment philosophy to life for a little bit, I thought I'd go through an example. And if we jump to the next slide, we can just show the history of our most recent investment in Dunelm, which is one of the leading homewares retailers in the UK. And this is an investment that we have had in the portfolio a number of times in the past, but most recently we added early in 2019 to the portfolio, which was catalyzed by, I guess, the initial evidence of the new management team's successful turnaround of this business, as Nick Wilkinson, who had joined about a year before then as CEO, and was really focused on improving what he called the operational grip of the business. So as everyone knows, retail really is about the detail. It's about managing all the small things that cumulatively add up to better profitability. And Nick had really put in place that focus. This is a good business. This is a leading homewares retailer in what is a fragmented market. So whilst they're a leading retailer in the space, they still have a single-digit market share. So lots of growth potential. And crucially, they have very strong multi-channel capabilities. So by that, I mean their online business. In the most recent quarter, They reported their online sales were nearly 30% of their total sales. So just to put a scale on it, which of course makes them a truly omni-channel retailer. One of the key aspects of that is the ability, as they develop their digital presence further, to really increase the customer lifetime value. So the idea being that they can acquire more customers and they can retain those customers, get them to spend more frequently with Dunelm, and thus increasingly build the value of that customer bank that they have developed. So we're getting all of that business, which is a highly cash generative business, at what we believe to be a compelling valuation, and where clearly the outlook for us anyway is positive. They have delivered very strong organic growth. And in fact, in their first quarter of this year, of this financial year, which was the months of July, August, and September, they delivered revenue growth of around 37%, clearly demonstrating, of course, that release of the pent-up demand coming out of lockdown, but also the increasing focus that consumers are putting on homewares as they spend more time at home and wish to improve the house. So we think it's been a huge beneficiary of that, but one that has great long-term structural growth, and it is thus a key holding for the portfolio. So hopefully that gives a little bit of a sense into how we think about making investments. And if we turn to the next page, we'll move on from the overview of the strategy to really how we're thinking about the world looking forwards, because this has been a challenging year. And this chart on slide 8 really just shows the magnitude of the economic drop that we experienced back in March and April. So a huge drop down in the economy, but then a pretty sharp bounce back through the summer. Of course, it has been varied by sector. Some areas really still struggling due to many of the restrictions that we're all facing, but other areas flourishing. The real question, of course, is what is the outlook from here? And if we turn to the next page, this doesn't give any answers. And we know that there are some areas of benefit and some tough areas. But we do believe that there is light coming at the end of the tunnel, if you will. So first of all, one of the specific considerations that we've had in the UK, which does directly affect the mid and small cap market more than the overall market, is the implications of Brexit. That has been weighing on the market, not so much the act itself, but more the uncertainty that it has caused, as we're not yet sure about the exact outcome in terms of trading relationships and the like. We are approaching, of course, the end date there. Secondly, the impact of COVID-19. Of course, as we saw from the previous chart, the UK has been very hard hit by that, in part, of course, due to the heavy services component of the economy, where services typically have been less resilient than manufacturing-based economies, and of course, the importance to the UK of the consumer. If we jump to the next page, this just talks about valuations in that context, which I think is worth noting. So yes, the economy has been hit very hard. We do think there is light at the end of this tunnel. And yet when we look at the valuations, they really are reflecting a lot of that negativity. And on this chart here, we just show the cyclically adjusted PE ratios for three key markets: the US, which is the light blue line up at the top, the EU, which is the next blue line, which is the second one from the bottom, and then the UK, which is the darkest line all the way along the bottom. The reason we're using a cyclically adjusted PE ratio, and this just takes the earnings, the average earnings over the last 10 years, is I think that's more reflective of the underlying earnings power of these three markets, as opposed to focusing just on a single year, when in this particular year, it's been so badly affected by COVID. And what we can see here is the UK is on around an 11 times ratio compared to around 14 for Europe and 29 for the US. So a huge discount. In particular of interest for me at any rate is that discount versus Europe, as typically over the long term through history, these two markets have tended to trade at very similar valuation levels. So I think there is a clear disconnect there that could be unwound as we move out through some of these uncertain periods. Now, if we could jump to the next slide, we'll talk about how the portfolio is positioned given some of those uncertainties around the outlook and the end markets. So the portfolio has changed through this year. We have absolutely adapted the holdings to reflect some of the changing opportunities that we've seen. But we can see on the left-hand side, those sectors where we have the largest overweights in the portfolio relative to the benchmark. And on the right-hand side, those sectors where we have the largest underweights relative to the benchmark. And first and foremost, technology, so software and computer services, is the largest overweight in the portfolio. This has in fact been the case for a number of years. So this doesn't purely reflect changes following the outbreak of the pandemic. But of course, a lot of these companies have traded very strongly through this period and so have benefited from that. So companies such as Computer Center, such as Softcat, which I mentioned before, are some of the largest holdings in the portfolio. Perhaps interestingly, general retailers is the second largest overweight. And this is, I find this to be a fascinating sector because, of course, it is one that is constantly changing and constantly evolving. And it's in the press the whole time as being under such huge pressure. But for me, the reality is this is a sector that is always full of winners and losers. And it is our job to find and get exposure to those winning business models. So Dunelm, which I mentioned, but also B&M, which is a discount retailer, another business that has done very well as a result of some of these changes. Other sectors where we have large overweights include the house builders, the leisure goods sectors, and the food producers, some of which you can see listed above. And then those are funded by quite material underweights in sectors where we're less positive on the outlook. So for instance, in the real estate space, where we think there are certainly challenges faced by those real estate companies, first of all, that own either retail or indeed office space. We think there are questions there over the likely direction for those valuations. But also then in travel and leisure, our second largest underweight, where of course consumption has been very heavily impacted by the virus, but also more importantly, a lot of those businesses are quite highly levered and so have been struggling really just to stay in business through this year. And so I think there will be changes there. We do have exposure, and in fact, as we look forwards, when we're thinking more about the potential recovery from COVID, as hopefully some of these vaccines come into use, as we see that recovery potentially coming through, we are actively looking at a number of companies in that space, and we already have quite significant positions in companies such as National Express and Jet2, two businesses which I think are ideally placed to come out of this recession in a very strong position and in a stronger competitive position than they went into. So businesses that really will, we believe, thrive when we come out on the other side, which of course will ultimately happen. And then just the final area that I'll talk about, maybe just for 2 minutes, is the food producers, one of the other overweights. And here we've got two holdings that are worth mentioning in particular. So Premier Foods and Greencore, which have had slightly different years this year. So Premier Foods, which is a business that has really benefited from some of the stay-at-home trends that we see. So Premier Foods owns brands such as Kipling and Bisto, and so clearly as consumption at home has increased, they have been able to sell more of their products and thus grow their sales and their profits through this year. In contrast, Greencore, which is probably most well known for making food-to-go products. So, for example, they make a lot of sandwiches for the likes of Marks and Spencer's and the Co-op, and they are one of the largest sandwich makers, indeed the largest sandwich maker in the UK. And clearly, they have had a tough time this year as mobility has really come down. So, in other words, as everyone has stayed at home. However, that is still a business that we think in the longer term has good growth potential. And so that's another example of a business that we think will come out of this downturn in a stronger competitive position, particularly as in fact, some of their competitors have been going out of business. So they've got the ability to gain new contracts and thus grow their business even further. So whilst this will have been a challenging year, we think the outlook for that business is in fact looking more promising. So hopefully I've given a bit of a sense of how the portfolio is positioned. We do, of course, think about trying to balance the overall shape of the portfolio, but it is very much built on individual stock picks. So it's a portfolio that's built from the bottom up as opposed to the top down, but where we think quite closely about the overall exposure of the portfolio. So if we jump to the next slide, which really is just the summary slide to finish off, hopefully I've been quite clear on what we think of as the structural benefits of investing in mid and small caps. So that superior growth that this end of the market can deliver, and how that can translate into superior returns over the long term. Hopefully I've given a little bit of an overview in terms of some of the uncertainties that we're facing in the near term, but that we actually think signs of an improving environment are emerging. So we've already seen pockets of recovery. Of course, we're going through a period of uncertainty at the moment whilst we're all under the lockdown measures that we're experiencing, but we've seen pockets of recovery. And I think there is light at the end of the tunnel, both with respect to the specific concerns that some investors may have had on Brexit in terms of the uncertainty caused by Brexit. There will be resolution there, but also as the vaccine developments begin to come through, which really could herald a return to normality at some stage in 2021. And at that point, we'd be on the clearly in the recovery part of the economic cycle. And then thirdly, hopefully I've given a little bit of an overview of the disciplined investment process that we use to manage Mercantile, and how that has translated into strong long-term investment performance, and that we really fervently hope to continue with that track record. So with that, I'd just love to thank you very much for your interest today, and also to remind you that we do have a booth in the virtual auditorium. So should anyone have any follow-up questions, please do drop by, and there'll be someone there to answer them. Thank you.